All right, welcome back to Power Lunch. As global risks rise, we kick off a special series this week looking at five-star Morningstar rated funds to help you navigate during these difficult times. We will zero in on a different sector each day, and first up is a focus on financials as banks get ready to report third quarter results starting Friday. Ian Lapey is portfolio manager of the Gabelli Global Financial Services Fund. It is up 9% this year, 45% over the past 3 years. I'll take that, Ian. Nice.
Oh, thank you.
Congratulations.
Thanks for having me on.
Congratulations. Are you by charter restricted or guided to invest in mid and smaller size banks, or could you, if you wanted to, invest in the granddaddies?
It's all cap.
It's all cap.
And global, so I also...
And yet, your biggest holdings typically are smaller banks.
Well, Citi is in my top 5.
Okay.
But First Citizens is my largest holding. That's about a $20 billion market cap. It really is a mix. And I really try to find undervalued securities with strong balance sheets and great management.
And that bank, First Citizens, is up something like 79% this year. What did you see, or when did you get in? And why do you like it so much?
I actually was a shareholder of CIT, and First Citizens bought CIT at sort of the depth of the pandemic, and they paid only 40% of tangible book. I was very upset, obviously, with that price, but upon doing more research on First Citizens, realized that I would be getting a better management team, so I elected to hold. So I've been a shareholder now for a few years.
And you put an emphasis on management teams that act like actual owners, like they run the business like they own the business, not like they're hired folks to come in and just manage it. How do you identify that quality?
Well, you're absolutely right. And I've been doing this for 26 years. And the more I do it, the more important I realize management is ultimately in the outcome. I'm a long-term investor. I look a lot at track record. So in the case of First Citizens, for example, since Frank Holding Jr. became CEO in 2008, tangible book value per share has grown at 17% a year, which is phenomenal compared to really any other bank. And then also insider ownership. You want management teams. I think they will tend to be much more focused on risk if they actually have significant skin in the game. So again, First Citizens, they own 13% of the economic ownership, which is about $2.5 billion. So clearly they have skin in the game, and they're not going to do stupid things.
When we talk about Gabelli, I mean, you're a value house. The KRE has just been slammed. It's down almost 30% year to date. The selling's been pretty broad-based. There's a lot of concern, especially now that we've seen longer duration bonds spike in yields to multi-decade highs, that we're going to see more unrealized losses coming into this earnings season. Where do you see value here? I would imagine there's been a lot of baby out with the bathwater, and there are opportunities.
Well, you're right. I think, unfortunately, in the U.S., a lot of banks during the pandemic reached for yield. They bought agency mortgage-backed securities to try to get a little bit better net interest margin than if they had just kept it in cash. And now they're sitting there with securities that are significantly underwater and likely to be even more underwater when they report earnings starting Friday. So I've been very cognizant of this, adjusting the capital ratios for the unrealized losses, whether banks are including them in available for sale as they should be, or many are holding them as held to maturity, which is debatable whether they should be. But to your question in terms of value, there's lots of value. I mean, almost all bank stocks are down this year. Not all banks have been poorly managed. Not all banks are undercapitalized. So I'm looking for ones that are strongly financed and undervalued. So one of my top holdings that everyone knows is Citigroup. It really has been the case of the shrinking multiple. If you go back to the end of 2019, they had a tangible book of 70. That's actually grown to 85 now, even after paying about $7 in dividends. The stock has gone from 80 to 40. So it's just massively undervalued, and their capital position has actually increased over that period. So at about 50% of tangible book, I think it's a great value.